I'm Brad Pappas, Executive Director of the Twin Cities FEI team, and we are thrilled you're here this morning for the 10th Annual Capital Markets M&A Update. We have a group of moderators and speakers here throughout the morning, and it's going to be great. We have 3 different sessions, and I think we're going to get started right away with our first presentation, and our moderator today is Joe Housman from BDO.
Oh, Brown and Brown.
Sorry, Brown and Brown. I knew it had a lot of B's in it. Okay, Joe, take it away.
I'm up. I'm going to stand up. So first of all, thanks again for coming. This is our 10th annual M&A update. I've been helping Jay Trumbauer put this together for probably the last 5 years, maybe, kind of just in a supporting role. So today, I think I was supposed to be doing the second slot, then I was doing the third slot, and he bumped me up to the first slot, which I'm happy to plug and play, but that means I have less to do because these guys are going to tell you all about the capital markets. We want to keep this interactive, so if you have a question, maybe catch my eye or raise your hand. These guys, I think, are going to be presenting from the podium. Just logistically, it's a little easier to refer to the slides. A little background. So I've been with FEI, I think, probably 6 or 7 years. I was on the board for a few years. I got involved when Hayes was selling to Brown and Brown. So we're still educating the marketplace. Brown and Brown is an insurance brokerage. I think we've got 300 people here in the Minneapolis office. Property and casualty, employee benefits, and we're proud to be a strategic partner with FEI. So thanks again for coming. I'm going to let Matt and Gaurav introduce themselves. So Matt, why don't you take it away? Thanks again for coming, everybody.
Thanks, Joe. Can you all hear me? Hey, good morning. So my name is Matt Norris. I'm with CIBC Capital Markets. CIBC is a Canadian bank with a global presence. CIBC bought the Private Bank Corp in 2019, which has commercial offices all throughout the U.S. And I've been with the firm for 9 years, focused on investment banking, servicing our clients throughout the U.S. on M&A as well as capital markets transactions. So what I'd like to do this morning is very briefly go over the capital markets, talk about where we've been over the last couple of years, what's been happening, and then looking forward on where things might be headed, and hopefully upward and to the left. So in terms of what we've been seeing over the course of the pandemic, significant headwinds from supply chain disruptions, material cost inflation, labor availability, rising interest rates, and geopolitical unrest, creating this perfect storm, disrupting economies, disrupting business models, and created a real challenge and, as a result, a very quiet capital markets environment. So then companies started to try and implement measures to address all these headwinds, which you can't fix overnight. But major approaches on nearshoring or friendshoring by moving manufacturing suppliers closer to home, or with countries that have friendlier political relationships with home. Yeah. Dual tracking suppliers, on having redundancies so you don't get caught up on those couple parts. It doesn't really matter which parts you're missing, but if you're making a school bus and you can't get windshield wipers or brakes, you can't get that school bus off the line. Price increases have been quite common throughout the economy in the U.S. over the course of the last year. However, this has taken time and put in significant strain on companies where there have been significant backlogs put in place, and it takes time for the old pricing schemes to run off and to start to get the benefit of new pricing. And so we're just seeing that towards the back half of this year, where we're seeing manufacturers have their margins improve from price increases that they put in place last year. So where we are now, many companies have record backlogs, which is quite positive for getting supply off the line and getting back to better top line numbers than we've seen over the last few years. However, it's still taking time for those price increases to come into place, and there does remain capital constraints as companies have waited to refinance their existing bank debt or finance new acquisitions or new developments. But what we are seeing in terms of the supply chain, on the left here is the global supply chain index put together by the New York Fed, and this takes together a bunch of measures from dry index to in and out freight, container shipping rates, delivery times, backlogs, and you can see that there's a significant downward pressure on the global supply chain, which is certainly positive. And then on the right, we're seeing that retail inventory to sales has come down significantly. So we're not seeing a significant increase in inventories now, and things are quite balanced with overall retail goods having about just over 1 month of inventory, which is on par for a normal environment. In terms of rates, we've all been seeing this significant series of hikes, 10 hikes over the last year, and now we have a pause. And it's certainly looking like there's going to be 1, maybe 2 more hikes before the end of the year, before we get into a rate cutting environment. But we are seeing, even though it takes time for these hikes to have an impact on inflation, we are seeing that core CPI come down. May's number came down to 5.3 for the core CPI, where the full CPI was down to 4%. So what does this mean for the capital markets? What does this mean? And we'll start with the debt capital markets. And before I talk about anything about rates, this is maybe a bit too small, but wanted to talk about sort of the evolution. So we don't need to look at the numbers or the words on the page, but going from left to right, you're going from a revolver-based lending to syndicated term loan to term loan B, and then to high yield notes. So sort of gravitating towards equity capital markets. And what smaller companies will want to do, or even mid-sized companies, is to utilize that revolver as much as you can. That's going to be your cheapest form of debt. And then as you increase in size and debt requirements, moving to a syndicated facility, and then into the capital market space. Now, I'm not showing all capital markets opportunities here, but more broadly, when we look at the debt capital markets for term loan B or high yield, we're looking at a debut issue size of at least 300 million. And that's sort of a benchmark that we use to guide our clients when they're looking to access the debt capital markets. There's a possibility to raise debt in the capital markets below that level. However, to achieve liquidity and enough distribution for the products to trade, 300 is kind of that minimum number. And if you're kind of backing out on, let's say, a 3 times leverage multiple, gives you sort of framing of about 100 million of EBITDA of the size of company when you'd be ready to access the capital markets. In terms of...
Can we go back to that last slide real quick? In terms of financial covenants,
Yep.
Obviously this marketplace has changed drastically over the last year. I'm curious if you could give a little bit of commentary of maybe not just financial covenants, but some of the other things around a loan. How have things changed over the last 12 to 18 months?
Yeah, there's we're still seeing maintenance covenants. Are you asking more on the debt capital market side or the bank? One thing that we're seeing is a shorter tenure. So here I have listed for the high yield 7 to 8 years, non-call 3. Now we're seeing a lot more 5, non-call 2. So we're seeing a lot of activity, much more activity in the high yield note space than the leverage loan space. And there you've got fixed interest rates on the bonds, and you've got a floating rate on the term loan Bs. And so issuers are taking advantage of the lower fixed rate rather than the higher floating rate right now. And then along with that shorter tenure, you're hoping to refi again in the near term.
So I probably should have done a better job introducing myself. I do a lot of M&A from an insurance due diligence standpoint, and so I think this is going to be a common thing we're going to hear from everybody is how have you seen deal flow and activity change, and what's the crystal ball for the future? My perspective is I did a lot of middle market private equity deals that kind of ground to a halt, and the only ones that were doing anything were the ones that had a bunch of cash on the sidelines and they could do an all cash deal and then maybe lever it up in the future. So I guess next question for you would be how have you seen deal flow change both in the debt and capital markets and the equity side?
Yeah, well, I'll get to the equity side in a few minutes. I think there was a lull over the last 18 months with limited activity as rates were moving. If I go to the next slide here on high yield, you can see while the rates have gone up significantly, the B index being that top yellow line, and the double B index being the blue line, at right now at 7.25 for the double B, and 9.17 for the B. You see that's kind of leveled off. So as that's leveled off, we've seen more issuances, and so this year to date, new issuance volume is up 46% over last year.
And this is just debt?
And this is just high yield, because on the levered loan side, new issuance is down 26% year over year, and that's against higher rates, right? So again, you have issuers that they're biting the bullet. It's like, okay, it's going to be higher for longer, and it's we can't just have money parked on the sidelines. We got to be opportunistic with our growth, and it's where it's going to be higher for longer. It's not only being opportunistic for growth, but next year there's this significant wave of refinancing requirements, and issuers in the back half of this year, I think, are going to be trying to get out in front of that.
Any idea why February was such an outlier? Is that just coincident, or maybe one or two deals?
Yeah, I'm not sure. Check on that. Good question.
We got one on Gary.
So Matt, just to follow up on that, the leverage side of that equation. So the leverage side of the equation, in terms of, has that changed dramatically? What's going on with interest rates going up? Has leverage changed in terms of what's allowed, what the market's accepting?
I would say generally no. However, there's short-term forgiveness. Certainly on the bank market side, seeing a lot of covenant relief, short-term covenant relief. Especially if you look at trailing EBITDA multiples for manufacturers, a lot of them are getting into their new price hikes now. They're realizing their price hikes, but the 4 quarters ago was still terrible, right? So they still need those old quarters to roll off for a nice LTM number. So we're seeing that. But in terms of going forward, leverage multiples on raising new debt, seeing it in the public market space, I would say still relatively conservative, relatively unchanged. And on the private side, there's still more room to be aggressive.
You smelling fear right now at all? Or are you smelling stability? What do you feel like? What's in the marketplace happening?
I would say not so much fear, but optimism and uncertainty. That helps.
I haven't had enough coffee yet.
So here in North America, we're seeing a mix between, if you speak to different investment advisors, you hear some people say that that's terrible. I'm just going to speak out loud. Yeah. So you hear a mixed bag of advisors saying that there is a recession in the near future that's going to happen with the interest rate hikes, and then others are saying that there are some possibilities of deals happening this year. So it's a mixed bag. It just depends on whose perspective you look at, right? There's just a lot of uncertainty right now. But we do know this, that the prospects here in North America look a little bit bleaker compared to Europe. Europe, they're a little bit more robust in terms of their outlook of deal activity.
you look back at the 70s and seen any comparisons? Because these are very low interest rates compared to the 70s.
Oh, that's for sure. But they're saying this movement is might even be more like 2007, 2008. That's the recent comparison that economists are drawing to.
Are you seeing multinationals offshoring debt to lower rate jurisdictions like Europe, Japan in particular, to match assets and liabilities from a hedging standpoint, things of that nature?
You're seeing a little bit more cross-border deals happening, but I've heard, so there's a survey that's done for the small to mid-size market. You're hearing a lot of interest from overseas into assets here in the U.S.
More rate chasing, right?
Yeah, it's a lot of it's rate chasing, because right now, if you think about it, last year the interest rates in Europe was what, 0%, and now they've climbed up 3-4 percentage points. It's been a little bit more aggressive there in Europe compared to here, whereas here it's been increasing over a period of time. So you're seeing a gradual increase. So in Europe, they're actually looking for opportunities here to potentially do some debt funding here, as well as, acquisitions. So that's what we're hearing right now.
Thank you.
Thanks, Gaurav.
Yep.
Maybe now we can pivot a little bit to talk about the equity capital markets. And here we're entering into, I guess, a changing environment. What investors look for is key three things: relative stability, positive market sentiment, and then demand for new issuances. And we'll start to talk about volatility, and this is the VIX index, which has been bouncing around over the last couple of years. And right now we're just around 16 here at the end of this chart. And one way to think about the VIX is the rule of 16. And if the VIX is at 16, then that says that the market is anticipating a 1% daily volatility for the next 30 days. Right? So back here in October, just before the bear market started to turn, the VIX was over 32. So there the market was building in a 2% expectation for a daily volatility in the equity market, in the S&P 500. And so that volatility has, an expectation for volatility has come down significantly, which has been quite positive for the equity markets. And here we have the Russell 2000 in the red line and the S&P 500 in the blue. And starting from October 22 up until today, we're now at in new bull market territory, with the markets up, with the S&P up 20%. Now, one thing to note here is that the Russell 2000 is only up 11%, which is still not bad, over the last 6 months. But it is suggesting that major players and the major tech companies are really what are boosting this and creating this bull market. But there's, I guess, and it was just the top 7 companies that were really lifting the S&P 500, accounting for about a third of the S&P 500 value, and we are starting to see some positive contagion with a next level of large corporates boosting the share prices. So that's all positive. So we've got more stability in the market, and you've got positive market sentiment. And what about demand? And Cava it's like a Mediterranean Chipotle restaurant chain, and they went public last week. And so they started marketing on Monday with a share price range of $17 to $19 a share. They priced it at $22 a share on Wednesday, and the first trade on Thursday morning was $42, up over 100%. The book was over 30 times covered, indicating that there's significant pent-up demand in the IPO market. And so we're satisfying these key three requirements for a potential IPO boom over the course of the summer. And with that said, there's a bunch that have been waiting in the wings. Who knows who might go first? One name that isn't on the page is Savers Value Village, a thrift clothing store chain throughout Canada and the US that CIBC has been involved in as a managing dealer. And this company we tried to bring public in the end of 21, and because of market sentiment, market tone, we couldn't do it. Paused for a year, tried again in January, and the market tone wasn't there. And then there was FTX, then there was SVB, then there was the debt ceiling crisis, and we launched this morning. So we're in a period of marketing with hoping to price next week. But we hope that we've found this window satisfying these two requirements for a successful IPO. And with that, I can pause for any, or we can finish off and answer any questions.
You said that you felt market tone had changed. Are you going out and testing some of the private equity markets, or are you testing some of your contacts? How do you know the tone has changed beyond that one incident?
Well, there's a mix. So it has to do with talking to institutional investors. It has to do with, I guess, navigating different data points that are coming out, whether it's the Fed or CPI numbers. It has to do with earnings releases of peers. So for this thrift clothing store, Dollar General, a dollar store, came out with their earnings 2 weeks ago, and that wasn't favorable. So that put us on pause a little bit. So there's a whole host of factors to try and triangulate on where we think market receptivity will be.
One of the, again, I'm going to try not to talk about insurance too much, but from an IPO standpoint, right, we saw a boom for several years, and then the last couple of years it's been very quiet. And from an insurance standpoint, the public company D&O insurance, we have been delivering significant increases for a number of years, and we're finally getting to be the ones now giving good news and giving price decreases on the premiums because there's just no activity. And so there's kind of a feeding frenzy within the insurance carriers that want more market share, and we're seeing those prices come down. So interesting supply and demand observation there. Questions from the group? I'd like to go back to, I think you kicked off the presentation talking about price increases, and so I'm going to throw the question out to the group a little bit. I'm curious to hear stories, examples of how your businesses are dealing with price increases. I'll share, I was in Chicago last week with a client, and they manufacture, let's just say, side dishes. So you go to the grocery store, and they're in Walmart or Target, and the box of sides, whether that's pasta or potatoes, they had not been giving price increases for probably the last 5 years. I think they had probably only gone with 1 or 2 price increases over the last decade, and they said that they've already done 3 price increases this year. So that box of pasta that used to be $1 at Walmart is now $1.50, and they've basically seen no elasticity. They haven't seen any demand drop, and I think we probably all as consumers feel it, right? You go to Target, it used to be a $100 bill, now it's a couple $100 bill. It's kind of shocking how it just racks up. So I want to throw that out maybe to Matt first, if you've got any clients that have seen that, but then also to the group. I'd be interested to hear stories from how you guys are dealing with price increases, and if you have any stories like that.
And I spend a lot of time in the manufacturing sector, and there I would say that the companies that have struggled have been the ones that have waited too long to implement price increases, and that there's been significant receptivity to price increases. But then I guess we're also seeing shipping costs come down, so we're starting to see a rebalancing where scarcity of goods is not as scarce, whether it's xenon gas or eggs, with the avian flu crisis now coming to an end and the price of eggs dropping significantly. But it's, yeah, I would say the ones that have gotten hurt and been pinched the most have been the ones that have been the slowest to implement increases.
I always find myself wondering when I'm walking through the grocery store, why is that aisle of chips empty, or why is the egg aisle empty? And there's a story behind everyone, right? The avian flu, maybe a plant got burned down, or maybe the goods didn't arrive from a boat. So, I want to hear other stories. Anybody else have an example from their business about how they're dealing with price increases? In the back.
So we've had about 4 price increases over the last 2.5 years, and we're now at the point where we're starting to go the other way. Conversely, we're asking vendors we're renegotiating all prices with our vendors. All this is in sync now because the price pressures that we're getting in the market are immense, and in order to move volume or move inventory, it's the only way to accommodate it is through price reductions. So it just started turning in the last probably 4 or 5 months, but it was the other way where the significant increases. So we see it kind of absolutely full circle. We call it pre-COVID, post-COVID. We're getting back to pre-COVID pricing, which is good to see.
Any observations on the labor side, labor costs?
Yep. So labor, we're still giving increases on labor, but that's softened up quite a bit in the last six months. The headlines in and of itself speak to what's happening with the labor market. The dynamic has changed where we have more supply of labor, but we've been in retention mode for our employees because the turnover is so costly that we still give sizable, merits or increases. I would anticipate over the next 12 months that it'll probably, get back to, follow suit to get more normalized. I mean, we saw the inflation go down. That'll continue to get pushed up too, sure.
Thank you. Anybody else want to share?
I work.
For accounting and finance overall, there's been a really interesting change. For accounting and finance overall, there's been a really interesting change for lower level transactional accountant. Actual salaries or hourlies has gone up pretty significantly, whereas higher end C-suite or controller level and up accounting manager now weirdly has not increased proportionally and in some cases at all, which is kind of bananas. And it has nothing to do with the amount of people available in the market right now. It's really, really strange. And I am really hoping that shifts soon because it's awkward.
From a supply and demand standpoint, you said that's not indicative of the number of people, but I feel like my pulse in the marketplace, there's the lower level jobs are snatched up real quick. There's a lot of turnover. Are you seeing that too? And not so much at the higher level?
It depends on what you're considering for turnover, because for things like, a lot of companies aren't focusing hard enough on their retention policies, frankly. But with a lot of uncertainty in the marketplace, there's a lot of M&A that's happening that's making people worried about the security of their own jobs. So if they're employed, they may be passively looking out of fear that they'll lose it at any time. COVID did a really good job of freaking people out with, 30 years at the same company and suddenly getting laid off. A lot of people saw that and panicked. So people are a little gun shy now when it comes to the actual stability of their positions overall. So I highly recommend retention strategies. It's very, very important. But the higher level positions, they're just going unfilled for months. Finance roles, higher level accounting roles, assistant controller roles, they're just putting all of that work on whoever is still there, which is obviously not great for retention. So it's kind of strange. I've never really seen that happen before in this volume.
I was going to say I work with some contractors, and they can't get transformers. If you look at some of the developments that are hurting They can't get transformers, which messes up the subs. So they're not paying more for the transformers, but they have to pay more to get the subs to come when the transformers do come in, and they're delayed by many, many months. And they're competing, the transformer manufacturers are competing, according to my subcontacts, with electric car companies. And they control the market for metals. So that's kind of where that's going.
I'm with a small, capital equipment business that we make water jets, so it's a lot of heavy steel component type stuff. So as we went through last year, it was very difficult from the supply chain side. It was not typical or atypical, I guess, to expect your lead times to double. So if I was expecting something in 2-3 weeks, it might be as long as a month, 2 months to get things. We particularly found it challenging to get computer-related equipment, so anything that you're trying to get from something overseas in relation to computer equipment was just painful. But that stabilized. So as we moved into 2023, I think we've seen and then steel prices as well. Last year spiked in the summertime, and then really maybe have stabilized a little bit. So as we sort of moved into 2023, lead times have started to come back. We're still seeing inflationary increases. We were probably running at, on a monthly basis, we could be seeing 1%, 2%, 3% inflationary increases in 2022. They're still coming through, but we've just been sort of diligent in regards to passing those costs along. And while our customers have maybe not, they haven't certainly pushed back on us, but especially in the capital equipment side, people are hesitant to make multi-$100,000 investments. Just given, I'm curious if you think that's driven by loan rates or just uncertainty, or maybe some combination of both. I think we're looking at just kind of being cautious, but moving forward with our business, and nothing's telling us to move backwards, I guess. So our labor force, we obviously out of COVID. We were cautious in regards to what we gave people for pay increases in the height of COVID, but once we came out, we were looking at labor increases of 8-9% per year. Now that it returned more to a normal 2-3% on average type role. So, anyways, that's just a little perspective from a small manufacturing business.
Thanks. Any final comments?
No, all good.
All right, thank you, Matt.
Thank you.
Hi there, good morning everyone. My name is Gaurav Ray. I'm a director in the valuation practice at BDO. So as you know, BDO is a public accounting firm. We're one of the largest, I would say the 5th largest in the country. And you might have also heard that in the news that we're converting from a partnership to a corporation. I've been with BDO for a little bit over 10 years now. My role is in the valuation practice is more towards the compliance side of things. So we do a lot of work once a deal has happened, you have to run purchase price allocation exercise or goodwill impairment, essentially putting assets and liabilities on the balance sheet once a deal has been struck. So we typically get involved at the closed end side of the deal. But oftentimes we do work with our due diligence colleagues who work mostly pre-deal. And so we help them with the due diligence side of things in terms of where market multiples are falling out. So hopefully everybody can see that. So as Matt mentioned, the year, this has been the 2nd year in a row where the setting for deal making has been plagued with a lot of uncertainty. There's been, in terms of outlook, there's been a mixed bag of where deals have happened. There have been successful deals that have happened, but many, in general, the overall deal size and in terms of volume as well as dollar numbers are definitely a lot lower compared to prior years. So this chart over here, for instance, this is from S&P Global Market Intelligence. We often rely on this as a way to see how and where the deal volumes are falling out. So if you compare Q1 of 2022, the deal volume was about approximately 5,000, a little bit over 5,000 transactions, with the deal size was around $441 billion. And now when you compare that to Q1 2023, the deal size is a lot lower, about 3,650 deals. The deal size itself, in terms of dollar numbers, is only $240 billion. January and February started off very slow, and then picked up in March, where you almost saw an increase from approximately a little bit under $60 billion in terms of deal size to about $133 billion in deal size. This is the first time since January 2022 where we've actually had a year-on-year increase in deal volume and in deal size. So there's some pickup that's been happening, but definitely when you compare it to prior quarters, to prior years, it's a lot lower. So, we've heard Matt talk through some of the factors that are influencing deal volumes. One of them is, and the biggest of all, is the turmoil in the financial sector with Silicon Valley Bank, with Signature Bank, two of the largest big banks, regional banks, essentially failing and then being acquired. Then you also had a fire sale relating to Credit Suisse, where essentially, we had this major fire sale take place. There's been some geopolitical unrest as well. The Russian and Ukraine war has been continuing for over a year now, and so there's some impact there felt as well. But the main thing that seems to be driving uncertainty this year is soaring inflation and rising interest rates, both of which have an impact on valuation multiples. If you think about it, higher cost of capital overall with the higher interest rates results in lower multiples. So there is essentially an inverse relationship. So you're seeing market multiples actually dip over a period of time. But what has been happening is that those market multiples are slowly coming back to the pre-pandemic levels that really soared in 2021 and then slowly has started to normalize. All right. The biggest M&A activity deal that has happened was with Pfizer acquiring Seagen for a little bit over $40 billion. And if you look at kind of the breakdown of all the deals, right, healthcare has been leading the charge on this. So even as late as March, even after when the Silicon Valley Bank failed, you still had a couple of deal volumes kick in. Pfizer did definitely lead the charge there. Then there was CVS acquiring Oak Street Health for about a little bit over $10 billion. So you have a lot of healthcare companies acquiring and trying to meet the market that's in the primary care field. So you're seeing a lot of acquisitions in that area. And we foresee that there is going to be continued activity in that area. In addition to primary care type acquisitions, we're also seeing a lot of investment happening in the healthcare technology field as well. As you're doing more telehealth medicine, you're starting to see more use of technology coming in and playing into these acquisitions. And then, in the other spaces, you have TMT activity happening as well, telecommunications, media, and technologies. There's been quite a bit of activity there as well. Energy and utilities have been fairly stable and fairly consistent with how things were at 2021 levels. And so that is being a pretty driving factor, but healthcare is definitely leading a charge and has been actually bringing the market up.
Take Gaurav. And if you go back to the slide before, I want to call back 2 years ago at this event. You know, the discussion, and it was from BDO, was like it was hotter than normal, meaning that there were tax law changes. There was more money looking for deals than there were deals. Due diligence was being skipped as a result, and I remember that coming out of this conference. And so now we're comparing to that, but I wonder if that was just simply an abnormal high, and we're actually returning to a normal, although it's balancing out.
That is certainly happening, because what you're seeing now is that people are paying more attention to due diligence right now, because you have so few quality assets that are out there, right? You still have money chasing quality assets, but there's just a shorter supply. So you're starting to see deals are happening, but they're taking of lesser quality assets, but you're also seeing a longer time horizon for deals to actually be executed. Back during the pre-pandemic levels, the due diligence process on average was about 11 months. Now they're getting closer to about 16, sometimes even as high as 20 months. So definitely a longer time horizon, so that people are no longer skipping due diligence as a process. And then, of course, the other thing that's happening is that if you look at the bid and ask price in negotiations, they're definitely a lot wider. So I think a lot of the sellers are still holding on to the old notion that I still have a lot of value in my company, so I don't want to budge on my sale. And then buyers are obviously seeing market multiples right now and saying that no, that things are not as high as they were. Back in 2021, things were normally high, so I'm not willing to go out there and pay for more at this point. I'm going to be a little bit more selective in my acquisitions now. So you have this big, much more wider gap between buyer and sellers at this point. But there are ways and means to where they're trying to bridge the gap. So that's a good point to raise there. So it is definitely coming back to a normal phase of how you think through things. You're starting to see multiples come down, but also earnings are improving as a result of good quality management through companies. Those companies that are financially strong, that are cash flow rich, EBITDA rich, they're getting much better multiples, which is what you would expect it to be, right? So when you look at deal forecast for Q2, what they're essentially, and this chart, by the way, is based on an online survey conducted by Firm X. This was as late March and early April of 2023. There are about 108 respondents. Most of them are in the small to medium sized environment. These are all deal advisors. And typical deal sizes are usually around $6 million to about $50 million. Most of the deal makers classify themselves as generalists. They're in the construction field, or they're in the telecommunications, media, technologies field. Some in the construction. So they're basically generalists. What they're seeing is that possibly, for the end of Q2, Q3, you're not going to have much of a movement in terms of deal volume for this time period, but you may start to see a little bit of a pickup after Q2 of 2023. Yep.
Just an earlier point, you had said multiples have been coming down. How much of that is driven by the lending market saying there's X amount we're going to really roll on this deal? We're seeing stuff, the sims that are coming through, and honestly, they're 5 to 8 in terms of multiples, and a year and a half ago was like 12. But is it more lending driven that's pushing it down, or
no,
just the market? Or?
Definitely. And I apologize this slide for being very, very small here, but one of the key factors, right, that are driving valuation multiples in general is basically the availability of credit in the market. Because, again, as I mentioned earlier, right, higher yields, higher discount rates, right, lead to lower valuation multiples. So they've definitely gone down. When you think about the private market, right, the small to medium size compared to S&P 500, right, both the large cap market and the small to mid cap private deals have seen a decrease in valuation multiples. But what is really, gives me a little bit of faith in the private markets is that the market multiples, even though they've gone down for the small to medium-sized deals, they haven't gone down as much as the market multiples for the large cap, those who are publicly traded company multiples. They have seen almost a big decline, a swooping decline in multiples compared to the small to mid cap private deals, right? They've gone down from the 12 times multiple to around 8 times, sometimes even as low as 6.5 times. But they have not gone down as significantly as you see in the public market. Since I have the slide up here, some of the factors in addition to that are actually discouraging deals from happening is inflation, rising cost of funding of debt, and then the big factor here that's actually encouraging more deals is the lower multiples. So because multiples are declining, they're expected to decline a little bit more later this year. That's actually encouraging sellers to come in to the market and actually sell their companies before they see a decline in multiples even further. And it's also encouraging buyers to come in and take a look at good deals. Geopolitical conflict does have some impact. It just depends on, when you think about a lot of companies, we talked a little bit about supply chain issues a while back, right? Because of what we saw in COVID, a lot of companies are trying to set up nearshore or have more production that is done domestically as opposed to overseas. And that is encouraging more deals to happen in that space. So when you look at precision manufacturing or any type of production that's taking place domestically or in nearby countries like Canada or in Mexico, we're starting to see a lot more deal volumes in that area. So there's some opportunity there as well. But yeah, inflation is definitely a big factor, big cause, big driver for lower multiples and discouraging people from getting into the market at this point. So when we look at valuation multiples in general, back in Q2 2022, 64% of those who took part of the Firm X survey said that the valuation multiples were too high, and that's generally what we had experienced. Now, if you ask the same deal makers, right, only 38% of the respondents are saying that the multiples are high. About 44% are saying that this is just where we would expect things to be, and 19% are saying that they're very low at this point. So we're definitely starting to see a shift from when people used to perceive multiples, valuations being extremely high to now they're starting to go down a little bit more. And as I was mentioning earlier, this is a comparison of M&A multiples versus publicly trading multiples. So back in 2021, the multiples had reached enormously high levels in the public sector. They were over a little bit under 18 times multiple. And when you look at private in general, they were closer to about 8 times multiple on average. And obviously, this is just an average number. Market multiples really depend on the industry and the size and quality of the assets. But if you take a look, there was a sharp decline in the S&P 500's EBITDA multiple, going from 18 times all the way down to a little bit over 12 times multiple. And then, whereas if you look at the M&A multiples, they have declined from 8 times to roughly over 6.9 or 7 times multiple. So the spread between public multiples and M&A private deal multiples have decreased quite a bit, and it's about a little bit under. The spread is a little bit under 5 times. So that's actually telling us that they're coming back to levels during the pre-pandemic stage.
Can I answer your question? Do you track the amount of dollars that are out there chasing deals to the multiples?
So that's a very interesting thing. So I think it was Bain Capital that said there is about $3.7 trillion of dry powder out there. But what is interesting is that they are not willing to let go of that capital just yet. So private equity has been a little bit more choosy in terms of the types of deals that they get into. Most of them tend to focus now, just in this environment, on add-ons as opposed to setting up new platforms. About a couple of years ago, I used to work for a big private equity firm out in Houston. They had started to set up multitude of platforms in the SaaS space. Some focusing on point of sales, others focusing on logistics. Some were focusing on Internet of Things, and they were setting up various types of platforms. Now, we're not seeing as many platform setups, but just basically a lot of add-ons. So, yeah, that's the nature of the deal. So even though there's a lot of capital out there right now, we're not seeing that big flow of capital into the markets. They're being very selective in this process. So yeah, about $3.7 trillion out there. So it kind of makes you think that once the market does improve, you're going to start seeing a big flow of capital come in. So probably the start of 2024. Hopefully, we overcome the recession hurdles, and we'll start seeing a flow in capital coming in at that point. So this chart here talks more about U.S. equity issuances activity. So this includes public common as well as convertible preferred equity. And so it covers from January 1st, 2021 to March 31st, 2023. This does not include any private placements. So in recent years, U.S. equity issuances have been boosted by IPO from SPACs. If you look at 2021, there were quite a few SPAC issuances. And they were ranging closer to about $8 billion worth of capital chasing. A lot of different acquisitions that were taking place. But now, as we look at it, the IPO market has dried up quite a bit, and a lot of that is due to the SPAC volume decreasing quite a bit from that point in time. Now you're only seeing closer to about less than $200 million worth of SPAC IPOs. There were only 8 SPAC IPOs in the last quarter compared to, I think, over 100 that were taking place in Q1 of 2022, and much more in the prior year in 2021. And then similar to what we're seeing on the M&A side of things, in terms of U.S. equity issuances in Q1 2023, healthcare again is taking the lead there. There have been quite a few investments, equity investments in the healthcare space. In fact, 8 out of the 10 largest deals were related to healthcare deals. So there's still a lot of activity in the healthcare space. They're nowhere near compared to what the activity levels were in 2021. So they still have a lot more to catch up. Energy and utilities. The biggest transaction that took place was related to American Water Works. That deal was about $1.7 billion in terms of equity raise. That took place in February, just prior to the Silicon Valley Bank failing. Biotech companies are still a big part of the healthcare space. So U.S. energy and utilities have been very stable and have been closer to 2021 levels compared to healthcare, where healthcare still needs to catch up quite a bit. So overall, in terms of conclusion or outlook, rebound in deal activity has been delayed, but it is expected to kick in later this year. Yep.
Back to the previous slide on healthcare sort of outperforming everyone else. Is that, there's two basic, thank you. There are two basic segments in healthcare. It's the provider side, physician group practices, medical groups, that sort of thing, hospitals and so forth. And then med tech companies. And so what would you say, do you have a sense of the split between those two segments, if you will, of healthcare?
That's a good question. I've been wondering the same thing. I think the split definitely is more towards on the home care, the primary care side of things. But technology investments still continue. They've been nonstop. But I think when I was looking at the CVS deal, or even with Pfizer acquiring Seagen, right, a lot of those acquisitions were related to primary care type deals. So that's where you see traditional retail pharmacy, making more acquisitions, or there being more deals happening along the vertical space. But I haven't seen the data yet that shows a split. But my strong suspicion is that most of it is happening in the primary care side, because I'm seeing a lot of that happen in a lot of the deals that I work with. So maybe I have a bit of a bias there on that.
Does your healthcare deal count include things like? Does your healthcare deal count include things like spin-outs? I.e., GE Healthcare. I know Medtronic is doing some spins. 3M Healthcare, for instance.
Yeah, so a lot of the deal activity volume that was in the previous slide, just a few slides back, this definitely covers M&A, it covers spin-offs, carve-outs in this space.
What do you think the driver is for the spin-outs?
So I think this spin-outs in general, what we're seeing is that companies are starting to focus more on their core business. And as a result, they're finding more success when they have these specialization companies go out alone, rather than being part of a company that has a lot of different services outlined. So companies are focusing more core business, so they want to do more spin-offs and carve-outs at this point, as opposed to making acquisitions that are not necessarily related to their core business. So I think that's probably the main driver behind that.
Thank you.
So in terms of outlook, we're seeing a rebound in deal activity has been delayed. But what is also happening is because you have a much longer time horizon for deals being executed, the way deal makers are actually starting to bring both sides, both the buyer and the seller, to the table is by introducing concepts like additional sweeteners into deals, such as giving the sellers the incentive to stay with the deal. Earnouts are a common provision that are being built in. Earnouts have always existed, but now they're building that more and more into deals. They're also giving rollover equity to sellers as well, so that they stay with the business, incentivize them to continue with the business, and contribute towards the business's success. So that's one way that they're handling in cases where deals have become a little bit more stagnant. In lower growth periods, companies are trying to find ways to maximize growth by focusing on not only on just on core businesses, but also optimizing their operating expenses. We have heard about more focus on operating expense control, cost of goods sold control. So they're finding ways and means they can control those expenses to help improve the bottom line. As I mentioned, private equity still has plenty of capital that is out there in the market, but right now they're focusing more and more on add-on acquisitions. And the environment is creating some opportunities. I think the healthcare space, SaaS space, there's definitely opportunities there. Even because of all the nearshoring and domestic production, right? That's to help alleviate the supply chain issues. There are more deals happening in that space as well. And then, of course, the pressure on the financial industry has raised concerns about a possible recession. You have more non-traditional institutions that are providing capital, that are introducing funding for companies, but the resulting impact of that is higher yield issuances, shorter time periods, and in some cases, especially with leverage buyouts, private equity firms, even though that's the common way of raising capital, financial institutions are reopening those covenants and trying to renegotiate those terms to make them a little bit more stricter. So that is.
So that's a little bit of a mixed feelings there.
Yeah.
Overall, do you see deal flow picking up, going down, big picture?
So I think there will be this stagnant phase for at least a couple of quarters. And because of concerns on recession in the horizon, you will probably expect to see a much lengthier process towards a deal being closed. So it's not that people are interested in closing deals, but they're waiting to see when conditions improve a little bit more.
On both sides, right?
On both sides, both buyers and sellers, exactly.
We have another 10 minutes, right, Brad?
Absolutely. Yeah.
Five to 10 minutes for this panel. So, I'm sorry, that was the last slide.
Yep, that was the last slide.
Any questions from the audience?
On your forecast side, what impact do you see from the, I hate to use the term, Inflation Reduction Act? As I understand it, I expect there's going to be a lot of money that hasn't yet been invested that wouldn't have been in the historicals, but it's going to be in the future.
Yeah, it's again, a lot of that is going potentially towards add-on acquisitions to continue to build up their platform, but rather than adding additional platforms to their field. Does that help a little bit? Or are you talking more generally about operating expense?
A lot, as I understand it, a lot of incoming dollars that weren't in your historicals, but will be in the future regarding energy and nearshoring for certain favorable industries such as chips.
Yeah, so those specific industries, there's definitely more investing happening there. So you would see a lot of deals happening in that space where you're having more investments in energy and utilities, solar panels, a lot of alternative to natural gas. So you're having more investments potentially expected in that space, and as well as production. Domestic production is becoming more important in order to alleviate some of that supply chain issue. So for those specific sectors, yes, but in the other sectors, not as much.
How is regulatory due diligence incorporated in the timeline of that? I know, for example, the U.S. Bank Union Bank acquisition was stopped for 9 months under regulatory review, so just wondering how that is in the timeline.
So yeah, environmental, social, and governance due diligence, that type of ESG as we call it, right, that is taking a bigger role during the due diligence process. It was not as important back in 2021, but it's slowly gaining more importance. It's not as significant, but it's still nascent compared to what it should be, right? But in order to optimize the valuation or create value out of these deals, they're starting to pay more and more attention to these types of regulatory, environmental, social, corporate governance. The private equity is, a lot of private equity deal makers are spending more time in this area because they realize that a lot of the sellers want these areas, want people to focus on these areas because those are the heart of their matter, right? So they believe that that's an area that they should spend a little bit more time in. So you're seeing some of that happen, and because of that, also once they clean up that, it takes a little bit longer for these deals to close as a result.
Can you clarify, your $3.7 trillion number, was that just the private equity overhang?
Yep.
And would that include family offices?
I'm not sure about family offices. I know this is, so this is from Bain Capital, who says that they're, at the end of 2022, they're still at $3.7 trillion out there.
Yeah, when you think of, that's the 3.7, that's the equity that's available, and you take a transaction value, even in a fairly conservative, kind of a 3x4 senior sub, you lever that up, that's a lot of transaction value, and then you think of the amount of corporate cash, not just the Warren Buffetts of the world, but I mean, there's a lot of corporate cash out there, and then the retirement, in particular in the middle market space of, the baby boom generation, it just seems like there's still a lot of tenure there for an incredibly active market in the next couple of years.
Oh yeah, it's still out there, but even though it's mind-boggling because you expect, with so much dry powder, you would expect more deals to happen, but because of this uncertainty that's looming for the remainder of this year and potentially kind of creeping into 2024, a lot of private equity, right, are not willing to go out there and make more acquisitions or give, even with equity funding. So they're being very, very selective right now in terms of putting that capital out there.
How about those funds that have a life cycle? Are they returning funds to investors, or are they putting it to use?
Good question. So I believe those that are in that process where they have to return their capital to investors, they're going ahead and doing that. But that's only after they've sold and exited out of several of their deals. Many of them who have earmarked financing, many of that $3.7 trillion, raised their funding back in 2021. So they still have about 4 or 5 years left, before they start they return that capital back. But you can imagine, because they raised it back in 2021, 2022, early part of 2022, they will need to go and find some of these deals happen. Otherwise, they'll just have to return that capital back. So it's interesting. I think a lot of this deal volume is going to start picking back up. Like, maybe not as much this year, but definitely in 2024. Once things start to improve, the outlook improves a little bit. It's also around the time when you expect more companies to plan their exits around that time as well. Because right now they're stalling a little bit. They want the environment to improve a little bit before they start selling their companies.
I think we have time for one final question.
Do you think the uncertainty of the 24 presidential election is also going to play into delays and?
Can you repeat that? Well, I saw people smiling, so I think they heard it, but I just asked if the uncertainty of the 24 presidential election is going to impact any of this.
I have not, honestly speaking, I've not heard so much of the election having an impact on deals. I can imagine that the geopolitical or even politics right now is not playing so much of an impact at this stage, but it might. It might in 2024. Everybody has a very short, they have a short, myopic vision of what's happening. Right now, they see inflation, they see interest rates, right, going up, and that's kind of the concern right now. But if you and I had this conversation in 2024, I'm pretty sure that's going to become a more important factor on people's mind. But no, that's a good question. Right now, not so much, but I can see it a year from now with that picture changing quite a bit.
There might be less of a looming threat. So for the last election, there was a concern about the Democrats coming in with higher taxation and that having an impact on future deals. Where here, regardless of your political stripes, it's either more of the same with the Democrats or not that looming threat from the Republican side on increased taxes.
Great point.
That's a good point.
Very good point. We're going to end there. So thank you again, Matt and Gaurav, for your participation. And we're going to break.
Thank you very much, Joe. We're going to take 15 minutes and refresh. It's pastries are back out there, and we'll see you in 15.